Good morning, and welcome to TOITOI Japan Market Radio for Saturday, March 21, 2026. I'm your host coming to you from Tokyo, and this is our daily briefing for global investors tracking Japanese markets. Joining me as always is our portfolio manager who specializes in Japan macro. Let's dive straight into what happened overnight.
Thanks for having me. So today we actually have a unique situation. The Japanese market was closed for a public holiday, so we didn't see trading in the Nikkei 225, TOPIX, or Japanese government bonds. That said, there's been significant news flow that will likely shape sentiment when markets reopen Monday, and I think it's worth unpacking those developments for investors with Japan exposure.
Absolutely, and the timing of some of these headlines is noteworthy given the holiday. Let's start with the banking sector, because we've seen a major headline out of Mitsubishi UFJ Financial Group. The story centers on margin compression as the Bank of Japan continues its rate normalization process. Walk us through what's happening here.
Right, so Mitsubishi UFJ, which is Japan's largest banking group by assets, is facing pressure on its net interest margins as the BOJ moves further away from the ultra-loose monetary policy that's been in place for over a decade. Essentially, rising rates are forcing a repricing of assets across the financial system, and that's squeezing the spreads that banks rely on for profitability. This isn't just a Mitsubishi UFJ issue. It's emblematic of the structural challenge facing the entire Japanese banking sector.
And why does this matter particularly for Japan right now?
Well, Mitsubishi UFJ is systemically important and a core holding in both the Nikkei and TOPIX indices. When you see margin pressure at this level, it signals potential earnings headwinds for the entire banking sector, which typically represents more than 10% of these indices. The broader context is that Japanese banks have benefited for years from wide deposit lending spreads in a low-rate environment, and now that policy regime is winding down. It's a transition cost that the sector has to absorb.
What's the likely impact on equities, the yen, and yields when markets reopen?
For equities, I'd expect continued pressure on the financial sector, which could weigh on the broader Nikkei and TOPIX. That said, the BOJ normalization process is actually supportive for cyclicals and exporters, so it's not uniformly negative. On the yen side, the rate normalization narrative continues to support yen strength through carry trade unwinding and capital repatriation flows. And for JGB yields, this reinforces the steeper yield curve story. We're likely to see the 10-year yield drift higher as the tightening narrative gains momentum.
So a mixed picture for Japanese equities, but clearer directionality for the yen and yields. Now, shifting to the equity market itself, we also saw some remarkable moves just before the holiday. The Nikkei 225 declined 3.38% on the last trading session, which is a pretty sharp single-day drop. What drove that?
Yes, 3.38% is substantial, and it reflects broad-based bearish sentiment across the Japanese equity market. What's interesting though is the divergence within that decline. While the headline index fell sharply, Meiji Shipping surged 13.84%, which tells you this wasn't uniform capitulation. There were sector-specific factors at play. The overall weakness likely came from either a significant negative catalyst affecting domestic sentiment or contagion from international markets, and we'll need to monitor whether this stabilizes or extends when trading resumes.
That divergence is striking. Meiji Shipping up nearly 14% while the broader market falls over 3%. What does that tell you about the underlying dynamics?
It suggests that shipping and logistics dynamics, possibly tied to global trade flows or fuel costs, are offsetting the macro headwinds. Meiji Shipping's strength indicates selective pockets of opportunity even in a risk-off environment. For investors, this underscores uneven market conditions rather than a clean directional move. The key question is whether the Nikkei's decline was a one-off or the start of a broader correction.
And what are the knock-on effects for the yen and yields from that kind of equity market weakness?
In a risk-off scenario like this, the yen typically benefits as a safe haven asset. So we'd expect JPY strength as investors rotate out of risky assets. On the JGB side, flight to quality flows should compress 10-year yields lower as investors seek defensive positions. That would potentially offset some of the upward pressure on yields we just discussed from the BOJ normalization story. So there's a bit of a tug of war happening here.
Got it, so safe haven flows versus normalization pressures on yields. Meanwhile, in corporate news, we're also seeing pressure on Brother Industries, the printer and industrial equipment manufacturer. The stock is facing headwinds from slowing printer demand and yen volatility. How significant is this?
Brother Industries is a large-cap multinational with significant exposure to cyclical hardware markets, printers, sewing machines, labeling equipment, and the company's struggles signal broader softness in Japan's industrial equipment sector. The printer market in particular is weakening as end market conditions deteriorate, and the company is also dealing with ongoing currency risk given the yen's recent volatility. As a constituent of the major indices, Brother's weakness can influence broader sentiment around Japan Inc.'s earnings outlook.
So this isn't just about one company, it's a potential canary in the coal mine for the industrial sector. What are the market implications?
For equities, Brother's underperformance creates a headwind for the equipment and machinery sectors, and it could weigh on the Nikkei 225 and TOPIX, particularly the hardware and industrial subsectors. There's also a contagion risk here. If printer demand weakness signals broader global manufacturing softness, we could see other Japanese exporters come under pressure. On the yen side, the volatility mentioned in the headline suggests ongoing currency uncertainty, and weaker corporate earnings guidance could theoretically reduce safe haven flows into the yen, though the directional impact really depends on broader global rate differentials.
And presumably limited direct impact on JGB yields unless this weakness spreads more broadly?
Exactly. The JGB market wouldn't react much to Brother Industries specifically, unless the weakness spreads enough to signal broader deflationary pressures or recession concerns in Japan's export-dependent economy. For now, it's more of an equity and currency story.
Right, so we're watching for whether this is isolated or the start of a broader trend in industrials. Stepping back, let me try to synthesize this for our audience. We've got a holiday-shortened week, but the news flow gives us three clear themes: banking sector margin pressure from BOJ normalization, broad equity market weakness with selective sector strength, and industrial exporters facing demand and currency headwinds. What's the through line here for global investors?
The through line is that Japan is in the middle of a significant policy transition, and that's creating winners and losers across the market. The BOJ's normalization is structurally supportive for the yen and yields, but it's creating near-term earnings headwinds for financials. Meanwhile, the equity market is showing uneven conditions. Some sectors like shipping are finding tailwinds, while industrials like Brother are struggling with demand and currency volatility. For investors, this isn't a moment to take a blanket view on Japan. You need to be selective about sector and currency exposure.
And on the risk side, we're watching whether the Nikkei's 3.38% decline was a one-off or the beginning of a deeper correction.
Correct. If bearish sentiment persists and we see the Nikkei test key technical support levels when markets reopen, that could extend the losses. On the other hand, if the selling was driven by holiday-thinned liquidity and we get some stabilization Monday, it may prove to be a buying opportunity in selective names. The catalyst behind Friday's decline will be critical to watch.
Great context as always. So for our global investor audience, the key monitoring points into next week are: confirmation of what drove the Nikkei's sharp decline, how banking stocks respond to the margin compression narrative, and whether industrial exporters see further pressure from demand softness. Keep an eye on yen strength as a safe haven theme and the ongoing tug of war in JGB yields between flight to quality and BOJ normalization.
Absolutely, and I'd add that with markets closed today, we may see some catch-up volatility Monday as investors digest this news flow. It's a good time to review Japan exposure and make sure positioning reflects this transitional environment.
Perfect summary. If you're a global investor tracking Japanese markets or managing Japan exposure in your portfolio, consider subscribing to TOITOI Japan Market Radio for daily updates. Thanks for joining us today, and we'll see you on the next episode.